Hello everyone and welcome to this session where we would be discussing about buyback of securities. Now this is a chapter which is highly scoring from an exam perspective. We do get questions on this in your exams. There are two types of questions that can come in. First is a standard question where you have been given the number of shares that you are going to buy back and you are asked to prepare the journal entries and sometimes even the balance sheet. Second type of question is there are certain limits which are prescribed and you have to figure out what is the maximum permissible shares that you can buy back. So the second part is what is more often asked in the exam, but nevertheless we'll discuss the questions and the concepts for both of them. Earlier, along with buyback of securities, there was another section which was pertaining to shares with differential rights. Now this has been removed from your syllabus, the new syllabus, and hence we don't need to refer that. If you are referring an old RTP or an old material where you have shares with differential voting rights, we don't really need to refer that because that has been removed in the new material May 24 onwards, which is applicable for September 24, 2025 and so on. So over here, buyback of securities. Now over here, we are going to discuss regarding buyback of equity shares. This is covered under section 68 and 69 of the Companies Act predominantly. In section 70 also there is there, but there are certain exceptions which are provided. So from an accounting standpoint, section 68 and 70 are what is more important. Now what is a buyback of security? In this case, when we issue equity shares don't have a redemption date or a redemption value. However, in certain cases, a company might have surplus cash with it and it might decide to either give dividend using that surplus cash or it might decide to buy back its securities. Usually buyback happens out of surplus funds and hence when I use this money to buy back my own shares, my number of shares reduces and thereby my EPS, which is net profit divided by number of shares, generally goes up because since buyback is from surplus funds, it does not really have any material impact on profits. Profits almost remaining the same, number of shares falling, your EPS increases, P/E ratio remains the same, your market price also increases. So buyback is a very good use of surplus funds that a company might have. Apart from that, there can be other reasons also for buyback where, let us say, a company wants to consolidate the shares which are held by the promoter and hence it might also do a buyback or any other pertinent reason. What we are more interested in, what will be the accounting treatment pertaining to buyback. Now for that we need to remember section 68 and section 69 of the Companies Act. The important provisions in these sections are, first of all, if a buyback has to be done, it has to be permissible or authorized as per the articles. So if your articles does not permit a buyback, you cannot go ahead and do it. Unless given otherwise, we'll assume that the buyback is permitted by the articles. It has to be authorized by the articles of association. Second, for a buyback to go through, necessary resolutions need to be passed. There are two possibilities. Either you can pass a board resolution whereby you can buy back up to 10% of your shares, or in case you want to buy back more, you can pass a special resolution in the general meeting whereby you can buy back around 25% of your shares. We'll do the detailed limits in due course. Second is the buyback either requires special resolution or it can also be done using a board resolution. Third, when you look at buyback, remember you can buy back only fully paid shares. Partly paid up shares cannot be bought back, and hence if there's a question whether a partly paid shares to be bought back, there would be a hidden adjustment where you first need to convert them into fully paid up shares and then go ahead and do the buyback. So it should be within the limits. We will discuss these limits and only fully paid shares can be bought back. Now this buyback, usually there is a time gap within which it needs to be completed. I believe this is around 12 months from the date the resolution is passed, and once a buyback is done, you cannot do another buyback within another 12 months. So if a buyback is done in a particular year, for the next 12 months you cannot buy back. So these are a few basic conditions pertaining to buyback. Further, section 69 over here says that from which sources can you do buyback. So buyback can happen either from a fresh issue. Now if you are buying back equity shares, then ideally you would not issue fresh equity shares, but you can issue preference shares. Preference shares are also belonging to the owners. So maybe buyback can be financed by a fresh issue of another category of shares, let us say preference shares. Or a buyback can also be financed from free reserves, which can be something like a profit and loss account, something like a general reserve, or even securities premium. Remember section 52 of the Companies Act specifies the uses that are possible for a securities premium. For a general company which does not follow accounting standards, they have 5 uses. That is, a securities premium can be used for the purpose of issuing fully paid bonus shares. It can be used for the purpose of writing off preliminary expenses. It can be used for the purpose of writing off cost of issue of debentures. or securities, it can be used for the purpose of writing of premium on redemption of debentures or premium on redemption of preference shares, and last, it can be used for the purpose of equity buyback. However, if a company is following accounting standards as per section 133 of the Companies Act, then there are only three uses which are permitted for the securities premium. That is, you can use it for the purpose of bonus shares, you can use it for writing of discount on issue or cost of issue of debentures, and third, you can write off for the purpose of buyback. So these are the three uses permitted. Basically two things, that is preliminary expenses write off as well as premium on redemption or premium on redemption of preference shares or debentures are not permitted for companies which are following accounting standards as specified by section 133. Now whether a company is following or not, we don't know, and hence in general you can make an assumption and solve for that. However, we are not studying redemption of preference shares per se over here, we are studying buyback of equity shares. And for buyback of equity shares, whether you follow accounting standards specified or you don't follow, securities premium can be used for the purpose of buyback of equity shares, and hence the sources from which you can do buyback is proceeds of a fresh issue of shares. Similar shares like preference shares, it can also be done in the last 2 or 3 months for the purpose of buyback. That is also eligible for the purpose of buying back equity shares, or it can be from free reserves, general reserve, PNL, revenue reserve, etc., or even securities premium. So securities premium can always be used for the purpose of writing off or for the purpose of buyback. Now over here, there is a very important adjustment which affects not just the buyback of equity shares but also redemption of preference shares. Buyback, remember, results in a reduction of capital base. It results in reduction of equity share capital or reduction of the capital base as the case may be. And hence, in case of a buyback, your share capital, let's say equity share capital, which is at face value, reduces, nominal value reduces. You can only buy back fully paid up shares. Now, against that, generally, the Companies Act is a little worried because earlier lenders, etc., would have given you loans, etc., looking at your current capital base. Now you are reducing your capital base, which makes it a little more riskier for the other parties or lenders, outsiders, etc. And hence they say that if your capital base is reducing, let's say you are buying back, for example, 1000 equity shares at the rate of rupees 10 each, which is a face value, and hence you are buying back equity shares worth 10,000, your capital will reduce by 10,000. Against that, let us say you are issuing fresh preference shares, another 400 worth of preference shares are issued at the rate of rupees 10, and hence your capital base is increasing by 4,000. So basically your capital base goes down by 10,000 and then increases by 4,000, and hence there is a net reduction in capital base by 6,000. Now this 6,000 has to be transferred from the free reserves, and over here free reserves can only mean revenue reserve, general reserve, or profit and loss, not securities premium. You can transfer 6,000 from the free reserves to the capital redemption reserve. There's a special reserve called as CRR or capital redemption reserve, and capital redemption reserve is a reserve which is not a free reserve, and it can be used only and only for the purpose of issuing bonus shares. Other than that, there is no other use for the capital redemption reserve. So over here, what do you need to see? Whenever there is a buyback, you will first need to figure out how much is the face value of the equity shares that are bought back. Compare it with the face value of the new preference shares, if any, that are issued, and if there is a gap, that amount, there is a hidden adjustment that you will have to transfer from the revenue reserves to the capital redemption reserve. There is a hidden adjustment that you need to do for both buyback of equity shares or even if there's a redemption of preference shares. So in a bigger question on buyback of equity shares, you can even have a redemption of preference shares. So when preference shares are redeemed, let's say preference shares worth 200, let us say, were redeemed, in which case your capital base goes down by 200 rupees, and if it is not backed by a fresh issue of shares, then you will have to transfer an amount equal to 200 rupees. That is the face value of the shares redeemed or the face value of the shares bought back. After considering the face value of the new shares issued, if any, that net amount will be transferred from the revenue reserve to the capital redemption reserve. And the only use of a CRR or capital redemption reserve is to issue bonus shares. So over here, we will see what is to be done when we are looking at the entries or the sums. So in case there is a reduction of capital base, equity share capital or even preference share capital as the case may be, which is not compensated by a fresh issue of new shares, then CRR, capital redemption reserve, will have to be created, and CRR can be created from the balance in the free reserve. That is, CRR can be, free reserves over here will be PNL, general reserve, revenue reserve, etc. It will not include securities premium. CRR will be used to issue fully paid bonus shares only, and there is no other end use for a CRR. Now, if there is a premium on buyback, is it possible that shares are of face value 10 but you are buying back at 50 rupees, in which case you will have to pay 50 rupees. So the journal entry, let us say if you are buying back one share, would be equity share capital account debit 10 rupees for one share, premium on buyback account debit 40 rupees, and to share buyback account, you will create a separate share buyback account where you will say that this is the amount that I have to pay 50 rupees. Now you will use the money that you have in your cash account to pay that. So share buyback account debit to bank. However, what will you do with the premium? Well, premium over here can be used, that premium can be written off against a balance in the securities premium or free reserves, that is general reserve, revenue reserve or P&L. There's no specific order specified, but in line with the institute solutions, we'll first utilize a balance in the securities premium because it already has limited uses, and then excess, if any, will be taken, let us say, from general reserve, and then if required from the profit and loss. Remember, this is a sequence that we will follow. This is a sequence that institute follows, but practically you can follow any sequence. Over here, premium on redemption of or premium on buyback of equity shares can first be written off against securities premium, then against general reserve, and then against P&L. Basically, your entry will be 40 rupees was a premium. Maybe you have some balance in the securities premium of 30 rupees or let's say 25 rupees. Your entry will be securities premium account debit 25 rupees. Then maybe another 15 rupees are there in the general reserve account debit, let us say 15 rupees to premium on buyback. So you will write off the premium on buyback. Secondly, there is a redemption, there is a buyback of equity shares, but it is not backed by new preference shares being issued, in which case the face value of the shares bought back is 10 rupees. Your capital base falls by 10 rupees, and hence there will be a hidden adjustment of general reserve account debit to CRR to the extent of 10 rupees. The things that you will have to remember over here is, while writing off premium on buyback of equity shares, you can utilize the securities premium as well as the other free reserves. But to create a CRR, you can only use free reserves and not the securities premium. When you look at redemption, premium on redemption of preference shares, it is a slightly controversial topic because it depends on whether your company is following accounting standards as specified or not following. Because if they are not following, then you can use the securities premium balance even to write off premium on redemption of preference shares. But for other companies who are following, you may not be able to utilize the premium because securities premium account over here has only 3 uses as we discussed earlier. So this is a little controversial, and hence if you want to play it safe, then the premium on redemption of preference shares, you write it off against general reserve, P&L, or if you want to utilize securities premium, you write a note assuming that company is not following specified accounting standards as per section 133. Then you can even utilize it to write off the premium on redemption of preference shares. So again, if I were to summarize for what purposes securities premium can be used, first, it can always be used for writing off premium on buyback of equity shares. Second, it can be used to write off premium on redemption of preference shares if the company is not following specified accounting standards. And third, it will never be used for the purpose of creating CRR. Are we clear with this? Okay, so this is the things that you need to remember. Premium on buyback can be written off against securities premium or even against other free reserves. Now, the illustrative journal entries, as we said over here, was the buyback entry will be equity share capital account debit. This is at face value. Premium on buyback, that was 40 rupees in our example, to share buyback account. Then you will make a payment. We have put that at the end. Payment for shares bought back, share buyback account debit to bank. Sometimes you might need to sell investments so that you generate that money. So your entry would be bank account debit, sale proceeds to investments, whatever is the book value of the investments, to gain on sale, which will go to the P&L account. And then you can probably do a buyback. Okay. Now, what will you do with the premium on buyback? If there is a fresh issue, then bank account debit to preference share capital or securities premium. Investments sold, bank account debit to investments, gain on sale. And then writing off premium on buyback. So over here, this premium will first be written off against securities premium, general reserve, and then P&L. This is premium on buyback write-off. However, there's also a hidden adjustment to create a CRR. So the premium on buyback can be written off against securities premium or free reserves. There's no order specified. However, in line with ICI solutions, we will follow this sequence as we just discussed. For creating CRR, on the other hand, transfer to CRR will be the general reserve or the revenue reserve, P&L, and then CRR. There is no securities premium used over here. There is no. Institute in some cases has used it, but I don't think that is appropriate. So we will not use a securities premium to create CRR. This is not one of the 5 specified uses for securities premium. How will you calculate this amount? Nominal or face value of shares bought back minus nominal or face value of preference shares which are issued. Now the second part over here is to find the maximum permissible shares which are allowed to be bought back. However, before you go to the second part, in the first part itself, there are a few special adjustments that can come along with a share buyback question, where you have to pass journal entries and prepare the balance sheet. I'll note down around 3 or 4 important adjustments. First, what if there is a redemption of preference share as well? And this redemption can be at a premium, in which case your journal entry will be preference share capital account debit with the face value, premium on redemption account debit with whatever is the premium to preference shareholders, and then when you make the payment, preference shareholders account debit to bank. Now, premium on redemption of preference shares can be written off in certain specified cases against securities premium, but in all cases against free reserves. So your entry will be the eligible reserves account debit to premium on redemption of preference shares. Remember, preference shares are also a part of share capital, and as a result, if preference shares are redeemed, then you will also have to transfer the appropriate amount, which is the face value of the preference shares redeemed, to the CRR. So like equity share buyback, there will be a hidden adjustment also in case of redemption of preference shares. Second, what if the question has that after the buyback etc. you are doing a bonus issue? Now, in case there is a bonus issue, you will be given a ratio. Let's say you have been given that there were 1,000 shares, out of which 200 shares have been bought back. That is 800 shares are remaining, and then the company decided to give a bonus in the ratio of 1:4. That 1:4 ratio, that is one new bonus share for 4 original shares held, you will apply, let us say, if it is after the buyback, depending on the date, you will say that if there were 800 shares after the buyback, divided by 4, there will be 200 bonus shares. Bonus shares are issued at face value, which is 10 rupees. So 200 into 10, that is equal to 2000. Now, bonus shares can be utilized or issued. What is a bonus share? It is a capitalization of reserve, and hence you will debit the reserves. Which reserve? First preference I will generally give to the CRR, because the only use of CRR is the issuing bonus shares. So first, capital redemption reserve, excess if required, securities premium account debit, and if more money is required, then you can take reserve, general reserve or PNL. Like you need 2000 for issuing bonus shares. There is, let's say, 500 rupees in CRR, so CRR account debit 500. There's 800 rupees in securities premium account debit 800, and then general reserve or profit and loss account debit for the remaining maybe 700 or so, 2 bonus shares. And once bonus shares are issued, bonus shares account debit to share capital. That is about it. Second special case, in case there is a bonus share. First special case was redemption of preference shares. Second special case is if there is a bonus share. Third, sometimes the questions have asked earlier, just to give you a background, there were 2 chapters in your accounts or advance accounts, which was redemption of debentures and preference shares, and there was ESOPs. These chapters have now been removed. However, the institute still can ask you questions on that as a part of adjustments. So like redemption of preference shares can also come and has come. Further, there can also be, let us say, debentures. Now, can you invest in your own debentures? Like when you look at shares, you cannot invest in your own shares. If you buy shares from your market of your own company, that is a buyback, and buyback rules of section 68 and 69 get triggered. In debentures, there's no separate buyback rules. However, if there were 1,000 debentures issued by the company at the rate rupees 10, there will be a debenture liability of 10,000. At the same time, if I decide to go to the market, because the debenture price has fallen, decide to buy 100 debentures at the rate 9 rupees, which are there in the market, 100 into 9, I'm probably spending 900 rupees to buy back 100 debentures. Now, can I show my debentures liability as 1000 into 10, that is 10,000, and investment in my own debentures as 100 into 9, that is equal to 900? Do you think that is appropriate? Institute does not think so. So it says that on one side you have a liability, on one side you have taken over or bought debentures, thereby you have kind of cancelled that liability, and hence you will cancel your investment in own debentures. Your journal entry will be debenture liability to tax extent will be debited, debenture liability account debit. For 100 debentures, I don't have to worry to pay anyone because I bought it. However, that is at face value, that is 10 rupees. Debenture liability account debit 1000. 2. Investment in own debentures 900, and hence there's a balancing figure of 100. That is called as profit on cancellation of your own debentures, which is typically a special transaction and not a day-to-day transaction, and hence institute usually takes it along with the capital reserve. We'll also take that along with capital reserve. There's no accounting standard for it. However, as per generally accepted practices, like when you do a share forfeiture and reissue, you take the balance to the capital reserve. In a similar way over here also, profit on cancellation can be taken against the capital reserve, though alternative treatment can be possible. So this is a third special adjustment in case there is a investment in own debentures which needs to be cancelled. Fourth, there is ESOP. Now, when you look at ESOP is an example of share-based payment where you go to your employees and you say that if you work with me, let us say for 3 years, then I will give you a chance to buy my share, which is worth 80 rupees at only 50 rupees. In which case, I will give you an option to buy at a 30 rupees discount. So the value of the option is 30 rupees. And the employee renders service over 3 years to be eligible for the option, and hence over the 3 years, you will record employee cost along with the stock option outstanding. Slowly, after 3 years, the employee can exercise the option, and the stock option outstanding, the value of the option was 30 rupees, will be appearing at 30 rupees. Now, when the employee exercises the option, what is the journal entry? For the company will receive money, that is 50 rupees on exercise of the option. So, bank account debit 50. Then you have stock options outstanding, because now they are no longer outstanding, they are exercised. Stock option outstanding account debit 30. 2. Equity share capital. With the face value, let us say 10, and the balancing figure is the securities premium, let us say that comes to 70 rupees. So, in rare cases, you might get a question like this. I have one particular question where this adjustment is there, and hence you should be aware that option should be valued at 80 minus 50, that is equal to 30, over the tenure of the employee service. That 30 will be recorded as an expense on the debit side and a stock option outstanding, like a salary outstanding, on the credit side. When the option is exercised, company will receive the money, so bank account debit. Then option is also exercised, so it's no longer outstanding. Stock option outstanding account debit 30 to share capital to securities premium. So that will give you the entry at the time of exercise in case of ESOPs. That is another, I believe, third special case. Fourth is probably creating CRR. When you create CRR, you will typically take the face value of the equity shares as well as preference shares, if any, redeemed. Against that, you might have issued new preference shares. So I will take the total face value of the shares redeemed minus the total face value of new shares issued, if any. However, is it possible instead of shares, new debentures are issued? If new debentures are issued, will I also take that? No. Issuing debentures is not reinstating your capital base. Issuing preference shares is reinstating your capital base. Something had gone down due to buyback, then it increased because you issued preference shares. That is not the case with debentures. And as a result, if you are issuing debentures, that is not going to be looked at while calculating CRR. You will only take the face value of the shares redeemed or bought back minus the face value of new shares issued. Face value of new debentures issued is irrelevant for the purpose of determining the amount to be transferred to the CRR. That is one thing that you have to be careful about. So I believe that these are, in all our experience, these are the few things. Sometimes the question might tell you that the preference shares were issued 2 months back. For the purpose of buyback, you can still consider them as face value of new shares issued for the purpose of transferring to CRR, and we'll do sums on this as well. So this is pertaining to all the new cases and new section, which I believe pertains to buyback of equity shares with the journal entry. That is first part. We will do sums on that as well. Before we do the sums, we will finish the theory ones. Then there is limits up to which buyback is possible. Now, section 68-69 provides 3 limits. Because otherwise what might happen is the company might take loans and everything, and then it might buy back all of its shares. The lenders will not be left with any equity to fall back on, and as a result there are limits up to which you can do a buyback. So there are 3 limits which are prescribed, assuming the company has authorized a buyback through a special resolution in the general meeting. If nothing is given, we will always assume implicitly that the buyback is authorized through a special resolution in the general meeting. There are 3 limits that you need to look at. First is the shares outstanding test. That is, the maximum number of shares that you can buy back is 25% of the shares existing pre the buyback. I'll again repeat, the maximum number of shares that you can buy back is 25% of the shares which are existing pre the buyback. That is called as the shares outstanding test. Over here, there's a maximum 25% of the number of shares outstanding before buyback you can buy back. Second is a resources test. How much money can you use for the purpose of buyback? So the standard says 25% of the paid up share capital plus free reserves, including securities premium over here, is the maximum amount you can spend for the purpose of buyback. So what you will do is, just before the buyback, you will try to find the share capital plus securities premium plus free reserves, that is general reserve, profit and loss, revenue reserve. That will be the total resources with the company. 25% of that is the maximum amount you can spend for buyback. But when you spend amount for buyback, you will have to divide it by the buyback price to find the number of shares that you can maximum buy back. Like for example, your total resources comes to 1000 into 25% comes to 250, and hence if I were to divide this by the buyback price, for example of 5 rupees, that will give me 50 shares which can maximum buyback. So under the second test we can say 50 shares are maximum that you can buy back under the second test. So maximum amount utilized for the buyback cannot exceed 25% of the paid up share capital plus free reserves before buyback plus the securities premium. Free reserves refer to reserves which are freely available like P&L, general reserve, revenue reserve. Securities premium, capital reserve, capital redemption reserve, statutory reserve, revaluation reserve are not free reserves. Though even over here we can add securities premium. We can't use it for the purpose of transfer to CRR. However, to find your total resources as per section 68 and 69, you can take your resource base including share capital plus securities premium plus the free reserves. You need to remember that. So securities premium where to be used? Well, it can be used everywhere except for transferring to CRR in general. Okay. And the third test is the debt to equity ratio post the buyback. Now be mindful, we are taking the debt to equity ratio post the buyback. So whatever is the debt to equity ratio post the buyback cannot exceed 2:1. Now for doing this working, you will have to do a lot of ways. There are a lot of shortcuts possible, mind you. What I would prefer doing is I would prefer to do the way institute does it, so that you can reconcile it with the study material solution, suggested answer solution, and it's a slightly longer way where you will follow, let us say you'll write down 6 points and prepare a working note. But this is exactly how institute does everywhere. So to keep consistency, we will follow that. Those shortcuts are possible, are also permissible in my understanding, but it's best to be on the safe side and follow the same method what institute does. So over here we need to find the debt to equity ratio, which the debt to equity ratio after buyback cannot exceed 2:1. Where debt over here, one needs to remember, will include what? It will include long-term debt. It will also include short-term debt. Short-term debt can be current portion of long-term maturities. It can also be short-term borrowings. It includes short-term debt as well as long-term debt, but it does not include other current liabilities like trade payables or outstanding expenses. No, it is just debt, that is interest-bearing items, that will be included over here. Both long-term as well as short-term, secured, unsecured will all be included. And equity over here will again include the paid-up share capital plus the securities premium plus the free reserves. So equity over here will be including everything, including the securities premium. And one needs to be remembering that this number cannot exceed 2:1 post the buyback. Now over here, it's best if you understand this with the help of a numerical, otherwise it gets a little confusing to handle. So we'll probably jump onto a sum where we will use a sum and explain how this is to be done, at least in the line of the format which the institute uses. At this stage, you just need to remember the rules. The rules over here are, for a buyback to happen, you should have, one can say, maximum 25% of the number of shares, or 25% of the resources can be utilized. So that is 25% of the share capital plus free reserves plus securities premium, whatever is that, divided by the buyback price. And buyback in such a way that post buyback your value cannot exceed, debt to equity ratio cannot exceed 2:1. This we will understand with the help of a numerical. I think question number 8 or so, 7 or 8 that we have, we'll use that as a base for the purpose of understanding the best. Question 9, I think we'll use this for the purpose of understanding this the best. And the least of the three, the lowest of the three, will be the amount that you will use for the purpose of buyback. Remember, because if you take highest of the three, then one of the conditions is met. For buyback, all the three has to be met, and lowest of the three will ensure that all the conditions are met. Now, generally, every time you will take 25% only. However, there's one exception. If the question, institute has never asked you a question like this, but it can very well ask you. If a question specifically tells you that the buyback is happening as per a board resolution, not a special resolution from the general meeting, based on a board resolution, then the limits will be 10%. Number of shares 10%, resources used 10%, though your debt to equity still post buyback cannot exceed 2:1. If it is lower, it is fine. It cannot be more than 2:1. So over here, the above limits, as you see, is assuming a special resolution is passed in the general meeting where 25% is there. If a board resolution is passed, the maximum limit is around 10%. That is what you need to remember. Now, other than that, the debt to equity post buyback cannot exceed 2:1 in either case. In exam, unless otherwise specifically given, we check everything based on 25% only. Now, shares with differential voting rights was earlier there. Now it is no longer there. It is not there in the study material. The name of the chapter and the content has been modified, and hence we will not go into that if it is not there. So there might be some sums that you see over here in old RTPs or compilations, etc., or books that you might have pertaining to differential voting rights, which you can safely remove. Now over here, there's also one more small thing that you need to be aware of. Again, this may be coming from for MCQs. Like if all of this will apply, let us say largely for an unlisted company. If you're a listed company, then SEBI rules will also apply over and above the Companies Act. And SEBI rules over here say that if a company has to do buyback using open offer, that is, you are taking from the open market, then maximum 15% of the number of shares can be bought back using open market. Institute has never asked you a question pertaining to this, but it is there in the study material that for a listed company, over and above all of these limits, one needs to ensure that if you're doing buyback by buying shares in the open market, you cannot buy back more than 15%. So your limit is 15%. So there are three limits. 25% in general for an unlisted company which is using a special resolution by the shareholders. 10% again for a company which is using a board resolution. However, if it is a listed company using the open market route to buy back, the cap is kept at 15%. These are three for MCQ purposes. From an exam perspective, you can safely go with 15%, and that will ideally give you the appropriate answer. So that largely takes care of the theory and concepts. We will go to the questions. We will review all the questions. We have marked down the last day revision questions from the classwork section as well as homework section over here. Having said that, we will discuss all the questions. First, we will go to question number 9. This is to understand that debt to equity ratio test, and this is where you will face some resistance. Okay. Once you get this clearly, you will usually not face a problem, but this requires a bit of practice. So let us go to question number 9, please. So let us try this. Pratham Limited, who is a non-listed company, has the following capital structure as on 31st March 11. So you have been given share capital and you have been given reserves, and then there are loan funds worth 42 lakhs. You are required to compute the debt to equity ratio, the maximum number of shares that can be bought back in light of the above information when the offer price for buyback is rupees 30 per share. In this question, they have not asked you to check for the other conditions like the shares outstanding or the resources test, only focusing on the debt to equity test. So over here, what are the steps that you should follow? The first step over here that you will always take, not just in this question but in any question, if you want to keep it consistent with the institute solutions, is you will first figure out what the loan funds are. In this case, if you go to see, the loan funds are around 42 lakhs. So let us say if I am doing this in short, let's say 42 lakhs. Second, part B, C and D are equity. Point B will say the minimum equity that you need. The minimum equity will be, if the debt to equity ratio is 2:1, that is 42 divided by 2, and hence this is around 21 lakhs. So minimum equity you need. However, what is your present equity? As per the buyback principles, you will take share capital, which is equal to 30 lakhs plus general reserve plus even the securities premium plus the profit and loss account. So if you will take 30 and 32.5 and 6 and 4.3 and another 30, I believe this is 72.8. So this is 72.8, which is your present equity. Now the problem over here is, one can say that means that your present equity, which is 72.8, even if it goes down all the way up to 21, that should work. That should be the amount that you can use for buyback. However, if the buyback happens, one needs to remember that you will have to transfer some amount from your present equity into the CRR, and CRR is not a free reserve. And hence over here, you will try to find the future equity. So point B, C and D are pertaining to equity. Your future equity will be your present equity of 72.8 minus whatever is the amount which is transferred to CRR. Now transfer to CRR will be based on the face value of the shares that are bought back into face value of the shares that are bought back, which we don't have, and we can assume it to be X. So these are the first 4 points. After that, you will have maximum amount that you can use for the buyback. This you can call as Y. And last is the maximum shares that you can buy back, which is nothing but the maximum amount divided by the buyback price of 30 rupees. So over here, this is what the institute, these are the 6 things that the institute will write in every question. And then it will prepare a working note 1 where it says, let the transfer to CRR be rupees X and the maximum amount which you can buy back, let's say that is rupees Y, in which case over here they will make 2 equations. You can do it as a shortcut as well, but if you want to keep it consistent with the institute, they will make 2 equations. They will say that, well, your present equity is around 72.8, out of which minus X will be transferred to CRR, which means whatever is remaining, that is your revised equity as compared to earlier. You look at minimum equity of 21. So maybe if you are required to transfer, let's say 20 rupees to the CRR, then 72.8 minus 20, that is equal to 52.8. 20 is just a hypothetical number. 52.8 it will be your equity minus, if you transfer, if you have to keep a minimum of 21 rupees, then what is the maximum amount you can buy back? Your maximum amount you can buy back is Y. And hence if I were to solve this, this is what 72.8 minus 21 will come to around 51.8. minus X will equal Y. This is your first equation. Other equation is the amount that is transferred to CRR, that is X, will nothing be but the buyback amount. Maximum amount you can buy back is 30. However, the issue price, buyback price is 30 rupees. So maximum amount that you can buy back is Y rupees. Number of shares that bought back will be the maximum amount divided by the buyback price, that is Y, but the transfer to CRR is into 10, that is a face value. And hence if I go to see, this is maybe 30x is equal to 10y, or loosely 3x is equal to y, which I can use to substitute over here, and therefore 51.8 minus x will equal 3x, and hence if you solve, 51.8 would possibly equal 4x, and hence x will equal 51.8 divided by 4, and hence this is around 12.95. Therefore y, which is equal to 3x, will equal 12.95 into 3, which is 38.85. So basically if you now have these numbers which you will use, let's say minus over here 72.8 minus maybe 12.95 will be your future equity if a balance sheet etc. was required, and hence this comes to probably 59.85, and maximum amount that you can use for buyback is around 38.85. But this is the maximum amount. If I want to find the shares, this would be 38,85,000 if I take the full number divided by 30. 38,85,000 divided by 30 will come to 1,29,500 shares that you can buy back maximum under this condition. So over here you can even review, I mean we have solved this over here. If you review this in proper detail with full numbers, as you can see over here, 1,29,500 shares. Basically you have started with the loan funds, then you looked at your minimum equity needed, present equity that you have, and future equity, that is minus transfer to CRR, and the last two is the maximum amount for the buyback divided by the buyback price will give you the number of shares. You make a simultaneous equation and get your answers. Okay, so we'll have to practice this a little more to get a grasp. You will see a lot of places where we were also doing shortcuts, but a lot of students preferred to do it the institute way, and hence we are also doing the way that is done by the institute. So this is your question number 9. Similar to that, there may be another question that we can refer, that is question number 4, which considers all the conditions, and hence we can use this, let's say, for our LDR working. So let's say if you go to question number 4, Perote Limited, who is a non-listed company, has the following capital structure as on 31st March 11. So it has been given data in crores, and the shareholders of Perote on the recommendation of board have approved on 12th of September a proposal to buy back. So shareholders have approved, and if shareholders have approved, that means 25% is the limit. If nothing was given, in any case you would have taken 25% as a limit. To buy back maximum permissible number of equity shares, considering the large surplus available with the company, the prevailing market value of the shares is 25, and in order to induce the existing shareholders to offer their shares, it is decided to offer a price of 20% over the market. So 25 plus 20%, and this will come to around 30 rupees is the buyback price. You are informed that the infrastructure development reserve is created to satisfy income tax requirements, so it is a statutory reserve, is not a part of the free reserves. You are required to compute the maximum number of shares that can be bought back in light of the above information, and under a situation where the loan funds of the company are 1200 crores or 1500 crores. So over here there are three possibilities. The given possibility where the loan is 1800, second if it is 1200, third it is 1500. Assuming that the entire buyback is completed by 9th of December, show the accounting entries in the company's books in each situation. So over here you have the entries as well as the maximum limit calculation. Over here you will first try to test the shares outstanding test. So the amount that you need to buy back over here based on the shares outstanding test. Second would be the resources test, and third would be your debt to equity test. Now whether the loan is 1800 crores case 1, whether the loan is 1200 crores that is case 2, or whether the loan is 1500 crores in case 3. Will your 25% of your number of shares change? No. So if I take your number of shares, you have probably 33 crore shares into 25, 33 into 25%, and hence this is 8.25. In any of the possibilities, this will be 8.25. Second, you will try to find your total resources, which is 330 on your calculators, plus will you take general reserve? Yes. Securities premium? Yes. PNL? Yes. So this is 330 plus 330 plus 240 plus 90 and 90, and hence this comes to 750. So this is your present equity, which is coming to 750. However, if I were to prepare a working note 1, I would say that your resources are 750. I can maximum use 25% of that. So 25% into 750 will actually come to around 187.5. This is the amount of money I can use. However, if I want to find the number of shares to be bought back, I'll divide this by 30, and hence I'll possibly get 6.25 crore shares. Again, over here loans are not used, and hence you will take the working in the exact same way. And then you will go to that same working like we did for those 6 steps. What institute does? A, B, C, D, E and F. Over here, when you look at the first case, there is loan 1800 over here, 1200 over here, and 1500 over here. Your minimum equity will be loan divided by 2. This is 900, this is 600, and this is 750. Now over here, if you look at your present equity was 750, including securities premium. So if I take that over here, I can say with confidence that in my first case, if my present equity is 750 and the minimum equity needed is 900, I cannot even buy back a single rupee because my debt to equity is already greater than 2:1. I cannot buy back anything. Even in the third case, when I look at 750, my minimum equity needed is 750, my current equity is 750, I cannot even use 1 rupee. So the amount used for buyback in 1 and 3 is basically 0. However, for the second case, maybe I will have to find a future equity, which is maybe 750 minus X. Now I don't know what X is. Maximum value for buyback is Y, and if I make a simultaneous equation, the transfer to CRR can be X and the maximum amount available for buyback can be Y. So I can say currently I'm having 750 minus I will transfer X to the CRR, and hence that is the amount that is remaining. After the transfer to CRR, minimum equity I need is 600 free, and hence remaining is the Y that I can buy back. So therefore I'll have 150 minus X is equal to Y. Transfer to CRR, which is X, will equal to Y upon 30. That will give you the number of shares to be bought back into 10, which is the face value, and therefore again you will have 3X is equal to Y. If you substitute it over here, this is 150 minus X is equal to 3X. Therefore 150 equals 4X, and therefore X equals 150 divided by 4, which comes to 37.5, and therefore Y, which is equal to 3X, will come to around 112.5. Now I will use this data over here. So this is 750 minus, I think 37.5, which is 712.5 of minimum equity. Now the maximum amount you can buy back has been 112.5. However, if I want to find the number of shares, this is 112.5 divided by 30. So this is 112.5 divided by 30, and this will come to around 3.75 crore shares. Now in the workings, if I go to see, in the first case I cannot buy back anything, in the third case I cannot buy back anything, in the second case I can buy back 3.75. Now at 3.75, which is the lowest of the 3, all the conditions can be fulfilled, and hence the maximum shares that you can buy back is possibly 3.75. If we just verify this over here once, let's say question number 4, you can see 3.75 crores to be verified if this is in a fair board note that we usually have. So over here, this is your overall working. And if the question is asking you to pass journal entries, now what will be the journal entries? In the first and the third case, there is no journal entry because you are not doing any buyback. However, in the second case, there would be a journal entry where you are buying back 3.75 crore shares. So your journal entry will be equity share capital account debit 3.75 into 10, that is 37.5. Premium on buyback account debit 3.75 into 20, that is 75 to share buyback account. So if I look at the entries, equity share capital account debit 37.5, premium on buyback account debit 75 to share buyback. I'll use I think 112.5 to pay. So this is share buyback account debit to bank. Let us say 112.5. Further, so after this is 112.5. That's you are paying. After this, what do we have? Sir, after this, we will have to write off the premium on buyback. Do I have enough money in my securities premium? Well, yes. In my securities premium, I have close to I think 90 rupees and I can use 75 to buy back. So premium will be used, securities premium account debit to premium on buyback. And lastly, I'll have to transfer to the CRR. This 3.75 into 10, that is 37.5. Maybe you will use general reserve account debit to CRR, that is 37.5, and that is about it. So over here, if you revise question number 4, a lot of things get done implicitly, properly. So this takes care of question number 4 and question number 9. Let's review the other questions again. Okay, before we proceed, I'll also discuss question number 7. It's a fairly manageable question, I would say, but it kind of builds you up to the journal entries before looking at the big balance sheets. And this is the same question in RTP November 19 and the same question came in RTP September 24. There is no difference in numbers as well. It's exactly the same question. So Umesh resolves to buy back 4 lakh shares of its fully paid shares of rupees 10 each at 22 per share. Okay, so 4 lakhs out of 4 lakh shares is agreed. Now, assuming this is within the limit, the buyback is in compliance with the provisions of Companies Act and does not exceed 25% of the company's capital in the current year. For this purpose, it issues 1 lakh 11% preference shares of rupees 10 each at par. Okay, the entire amount being payable along with applications. So maybe for preference shares, I'm issuing new preference shares. So my journal entry be bank account debit 1 lakh into 10, that is 10 lakhs to 11% preference shares 10 lakhs. Okay. The company uses 16 lakhs of its balance in securities premium apart from the adequate balance in the general reserve to fulfill the legal requirements regarding buyback. Give the necessary journal entries to record the above transactions. Now, what will be the journal entries? First is issue of preference shares. The entry for that will be bank account debit. Now, you can create a share application, share allotment, everything, but ultimately to 11% preference share capital. This will be 1 lakh into 10. This is equal to 10 lakhs. After this, there is a buyback of 4 lakh shares. So this will be equity share capital account debit 4 lakhs into 10, that is equal to 40. Premium account debit, that is 4 lakhs into 12, this is 48. To share buyback account, which is around 88. And I will pay that off, share buyback account debit 88 to bank 88. Now, the premium has to be written off. 48 will first be written off against the balance in the securities premium. So your entry will be securities premium account debit around 16. Then you will have general reserve account debit, whatever is the remaining, and then to premium. The premium over here is 48 and hence I believe the remaining 32 will go against the general reserve. Now you need to create a CRR. However, a student typically says CRR is created if 4 lakh shares are bought back, 4 lakh shares into 10, that is equal to 40. So CRR should be created for 40. However, is there any preference share to be issued? Yes. And hence your CRR to be created will be the equity shares bought back face value minus the face value of preference shares. So this is 4 into 10, that is 40 minus 10 of new preference shares face value issued, and hence 30 will be transferred to the CRR. So over here, if you review the entry for this, let us say if I can just open this up, question number 7 and 10 over here. As you see, bank account debit to preference share capital. Then equity shares premium, you will use securities premium and general reserve to buy back. And last May, when I transfer to CRR, it is only 40 minus 10, that is equal to 30. So this kind of takes care of question 7 as well as question number 10. The next thing that you go to over here is your standard questions where you are just asked to pass the journal entries. It's very easy and scoring in case something like this comes. Though most of the questions that we usually get are questions involving that maximum permissible limit, or in sometimes there might be combined questions as well. So you'll have question number 1. M furnishes the following balance sheet as on 31st March 11. So you have the entire detailed balance sheet. Company passes a resolution to buy back 20% of its equity capital at rupees 15 per share. 20% of its equity capital. How much is the equity capital? 3 lakhs into 20%, which means 60,000 equity shares you are going to buy back at the rate rupees 15 per share. For this purpose, it sold investments of rupees 30 lakhs for 25 lakhs. So there will be a journal entry where you will sell the investments. Bank account debit 30 lakhs to investment. No, bank account debit 25 lakhs. I believe you are selling this bank account debit 25 lakhs to investments 30 lakhs, and hence there will be a loss which will go to the profit and loss account of 5 lakhs. So basically after this your investments would be all of this is given in thousands. So 25 lakhs maybe is what? Kitna hai 1000 mein 25 lakhs is maybe 5,000. So this is 2,500. 1 lakh is 100,000 and hence 25 lakhs is 2,500. So this is minus, I think, 2 investments. This will be 3,000. In my bank, I will add 2,500 and then there is a loss which will be reduced from the profit and loss account. So over here minus 500. That is 5 lakhs or 500,000 ka loss. Okay. This is a slightly different entry. What are you supposed to do, sir? Just pass journal entry. So this is the first journal entry. If it was required to prepare balance sheet, we would have prepared that as well. Now there is no redemption of preference shares. There is no new issue of preference shares, and hence your entries will be direct. So I will say equity share capital account debit 60,000. Let's say in thousands this is 60 into 10. So this is 600. Premium on redemption. This is 60,000 into 15 minus. This is 5. This is 300. 2. Let us say you will have. In this particular case, what do you say? You will have a share buyback account 900. Then share buyback account debit to bank 900. Now this 300 of premium will be written off first against what? So securities premium. Do I have enough balance? Yes. So securities premium account debit to, let us say, premium, and then whatever 600 will be transferred from the general reserve or revenue reserve to the CRR. So if I look at question number 1, the first question to start with, you will see 60,000 shares are bought back. You will pass the entry for sale, buyback, and the entire buyback is adjusted against securities premium, and whatever is the face value of 600 is transferred to the CRR because there was no fresh issue, and hence the entire 600 goes to the CRR. It's an open and shut question. No balance sheet required per se. Then you go to question number 2 where you look at a similar question, just that you are asked to prepare the balance sheet probably. So Anu is a non-listed company, furnishes the following information. So you have been given all of this balance sheet, and the company, okay, there is another adjustment over here that the company redeemed preference shares on 1st April 11. So if you are redeeming preference shares, remember again there will be a creation of CRR. It also bought back 50 lakh equity shares of rupees 10 each at rupees 50 per share. So there's a 40 rupee premium. The payments were made out of the huge bank balances which appeared as a part of the current assets. You're required to pass the journal entries. First is the entry for redemption of preference shares. For redemption of preference shares, this is 12%. Preference shares account debit 75 to preference shareholders 75. And then preference shareholders account debit 75 to bank 75. Ajay, so the preference shares have been redeemed. However, 75 is a reduction in capital base, and hence you will have to create a CRR for 75 at least. Apart from that, you are buying back 50 lakh ordinary shares. So over here, your entry would be equity share capital account debit 50 lakhs into 10. This is equal to 500. Premium on redemption account debit 50 lakhs into 40. This is around 2000. And to share buyback, this is 2500. Then there is share buyback account debit to bank. So over here, this is given in crores. Achha, all of this is lakhs. If I were to do it in crores, this is 5 crores, 20 crores, 25 crores. So over here, if this was in crores, 5, 20 and 25. So this is 75 minus 75. So this will become 0. Money was used from your bank account. 340 minus 75. Other than that, in share buyback, again share buyback account debit to bank, another 25 crores must have been paid for equity share buyback. Your share capital went down by 5. But there's a premium of 20 crores. With whom will you write off the premium? First against securities premium. Yes, the entire premium will be written off against securities premium account debit to premium on redemption. And now you'll have to create a CRR. Now CRR will be created for the face value of equity shares redeemed, that is 5, as well as the face value of the preference shares redeemed. That is 5 and 75, that is 80. Do I have enough balance in the revenue reserves? Yes. So there will be revenue reserves account debit, let us say 75 and 5, that is 80, to a CRR which gets created for 80. So over here minus 80, and then there would be a CRR which will get created for 80 rupees. And probably that should be it. Later, in your share capital, you will see equity shares of 25 minus 5, that is just 20 crores, preference shares are 0. In your reserves, your capital reserve will remain intact at 15. Your CRR will be created at 80. Securities premium will appear at 5, and revenue reserves will appear at 260 minus 80, that is equal to probably 180. So if you just review this question number 2, preference shares are redeemed. So 75 ka entry, then equity shares, the premium on buyback over here, as you can see, will be written off against the securities premium, and revenue reserves 75 plus 5, that is equal to 80 rupees, will be used for the purpose of creating CRR. Now if I have to prepare the schedule 3 balance sheet, my share capital will only comprise of equity capital. Reserves, as we said, will comprise of CRR, capital reserve, 5 of premium, and 180 in the revenue reserve, that is 280. Other than that, your PP will remain the same. Your non-current investments, nothing was sold over here, will remain the same. If there's a market value disclosure, you will give that. And the current assets, which were earlier probably 340 minus 100, will become 240. So this is regarding question 2. Question 3, I would say, is an important question for your last day revision, because it has redemption of preferences, that too at a premium. It has ESOPs, it has own debentures which need to be cancelled, so a lot of things. So let's mark this as important. Now Extra, which is a non-listed company, furnishes the following information of the balance sheet on 31st March 11. So over here you have this entire balance sheet, may be given in a T form, it can also be given in a vertical form. The company redeemed the preference shares at a premium of 10% on 1st April 11. So over here, if you were to redeem these preference shares, this is 20 redeemed at a premium of 10%. So this will be preference share capital account debit 20, premium on redemption account debit 10%, that is 2, to the preference shareholders 22. Then you will pay off the preference shareholders. This is preference shareholders account debit 22, to bank 22, maybe. However, there's a premium. Now this premium can be written off against the securities premium if the company is not following the accounting standards as specified, or against other reserves. Institute over here is written off against securities premium. You can alternatively also write it off against other reserves. So if you follow the institute solution, securities premium account debit 2 rupees, to, let us say, the premium on redemption of preference shares of 2 rupees. So over here minus 2, over here minus 20, and in your current assets minus 22. So these are the entries pertaining to sub point 1. It also bought back 3 lakh equity shares of rupees 10 each at rupees 30 per share. So over here your entries would be the same: equity share capital account debit 3 lakhs into 10, that is equal to 30. Premium on redemption account debit 20 rupees, so this is 60. 3 lakhs into 20, and to share buyback account, which will be 90. And then buyback account debit to bank, this will be 90. So your equity share capital you will reduce by 30. Okay, this is I think wrongly printed over here. Then your current assets you will reduce by 90, and then there is premium. Now this premium will be written off against what? Well, typically this premium will be written off against securities premium to the extent the balance is available. Currently, if you go to see in securities premium, there will be a minus 60. Ideally you can adjust only 58, and 2 will be adjusted somewhere else, but as you will read further in the question, there will be some more premium that will get created, and hence for the time being we will adjust the entire 60 over here. If there was no other adjustment and this was the only thing, then 58 would be adjusted over here, 2 will be adjusted against other reserves. For the timing, this is about it. Now there is a redemption of equity shares, buyback of equity shares, and redemption of preference shares. Equity share capital is debited by 30, preference share capital is debited by 20, and hence there will be transfer from the general reserve to the CRR. So there will be an entry of 20 plus 30, that is equal to 50. So this is revenue reserves account debit, which is 50 to CRR 50. So your revenue reserves will become 0. In fact, a CRR will be created, let us say at 50 rupees. Okay. Next, the payment of the above was made out of the huge bank balances which appear in the current assets. Fair enough. Included in the investments were investment in own debentures costing 2 lakhs with a face value of 2.2 lakhs. Now, in your debentures, there's a 2.2 lakh debenture liability. So you will reverse that. So you will say debentures liability account debit 2.2 lakhs to your investment in own debentures, which was 2 lakhs. And hence a balancing figure of 0.2 will be the profit on cancellation. Now this is a special transaction, hence usually this is taken along with the capital reserve. So over here, if I were to prepare the balance sheet, I will say debenture liability will reduce by 2.2. Your investment in own debentures will reduce by 2 because investment is credited by 2, and your capital reserve will increase by 0.2. That is what the institute has done. Okay, then you have these debentures were cancelled on 1st April. Okay, so you have eliminated those investments. It's your own debentures, and this is an ESOP. This is the only place. Earlier there was a chapter on share based payment, now it has been removed, but if an adjustment comes, you should be aware. So the company had 1 lakh equity stock options outstanding on the above mentioned date to the employees at rupees 20 when the market price was rupees 30. So these options give you a choice to the employees to buy the shares at 20 when the market price is 30. So what is the value per option? So the value per option we can say is 10 rupees. And as per the guidance note on share-based payment, you will record this 10 rupees over, let us say, the 3-year time or the number of years the employee is going to render service, which was included under the current liabilities. On first, so maybe 10 rupees per option into 1 lakh such options, that is maybe 10 lakh rupees was included within current liabilities. On 1st April 2011, employees exercise their options for 50,000 shares. Now over here, what is the entry? When they exercise the options, they will have to pay money. So the company will receive the money. So your entry will be bank account debit. This will be 50,000 or 0.5 lakhs into 20. And hence I will receive 10 lakhs in my bank. Then I will issue equity shares. So equity share capital 0.5 into the face value, that is equal to, let's say, 5. However, now can I say that when I was saying earlier in my current liabilities, stock options outstanding were 1 lakh at the rate rupees 10. Are they still outstanding for 1 lakh? No, it is like outstanding expenses paid. In which case, your stock option outstanding, which was earlier appearing, will now be debited. And hence this is 5. And the balancing figure will go to the securities premium. This is 10. So if I were to give effect to these entries, my bank balance will actually go up by 10. My current liabilities will actually go down by 5. It is included currently in the current liabilities. My share capital will go up by 5, and my securities premium will go up by 10, and hence I have enough money now in my securities premium as well. Okay, so this is pertaining to this ESOP. I think in the exams they will not ask you this because the chapter on ESOP is removed. Earlier the chapter was there, but if it comes, you should be aware. Pass the journal entries for the above and then prepare the balance sheet. So if I were to prepare the balance sheet, in my balance sheet I will have 100 minus 30, that is equal to 70 plus 5, 75 worth of equity share capital, 0 worth of preference share capital, capital reserves worth of 8.2, revenue reserves of 0, securities premium will be probably 8, debentures will be 1.8, CRR will be 50, and my current liabilities will be 65. So you can check this. I'm just discussing it so that you are aware. And then on your fixed assets will still be at 50, investments will be 118, and your cash will be 142 minus 22 minus 90 and plus 10, so probably 40 rupees worth of cash. So if I were to verify this, it's a fairly important question. Over here we have adjusted securities premium for these. You can also alternatively adjust the revenue reserves if they are available. Then premium on buyback, again adjusted against securities premium, revenue reserves to CRR for 50, that is 20 and 30, redemption of preference shares as well as equity shares, and then a new entry for profit on cancellation going to the capital reserve, a new entry for ESOP that we passed, and then we prepared a balance sheet. As you can see, balance sheet will have share capital of 75. Within reserves, your CRR will be at 50, capital reserve will be at 8.2, revenue reserve is 0, securities premium as you said was 8, and hence this is 66.2. In your long-term borrowings, there will be 1.8. In your current liabilities, there will be 65, and that will give you, and other current assets or cash was around 40. So that will hopefully give you a broad level understanding for this question. This is question number 3. Now, question number 4 we have discussed. Question number 5, let's review this over here. What is asked at the end? You are required to prepare the necessary journal entries towards buyback and also prepare the balance sheet after the buyback of shares. So over here, if you look at question number 5, equity shares, then there are bonus shares which are already issued. So basically, for all practical purposes, 13,50,000 worth of equity shares. There's an stock option outstanding account over here. Revenue reserve, securities premium, capital reserve, unpaid dividend, 12% debentures, advance from related parties, current maturity of long-term debts. So an application money due for refund. This will go in other current liabilities. Unpaid dividend will also go in other current liabilities. Now the company wants to buy back 25,000 equity shares of rupees 10 each on 1st April 16 at rupees 20 per share. Now they could have also structured this question in a way where they could have told you to find a limit and given you some more data. Here they have given you 25,000 and the buyback is duly authorized by the articles and necessary resolution has been passed towards this. Buyback of the company is also within the provisions of Companies Act, so you don't need to check anything. You need to check only if the question specifically asks you. The payment for buyback of shares will be made out of the sufficient balances in current assets. You are required to pass the necessary journal entries towards the buyback of shares. It's quite easy actually. 25,000 equity shares into rupees 10 each. So over here there's no redemption of preference shares. So there's equity share capital account debit. This is 25,000 into 10. This is 2.5 lakhs. Premium on buyback account debit at rupees 20 per share. This will also be 2.5. And to share buyback. This is 5. Then share buyback account debit 5 to let us say bank. You will have 5. So your equity share capital, which was earlier 13.5, is falling by 2.5. Bank, which is in fixed assets, will actually fall by 5. Share buyback account is a temporary account which will close. Now premium of 2.5 will ideally be written off against the securities premium, which is exactly 2.5. And hence 2.5 minus 2.5 will become 0. Okay. So over here, this will be 2.5 minus 2.5, which will become 0. So your securities premium will also be utilized. And your entry over here will be securities premium account debit to premium. This will be 2.5. Okay, now you need to transfer money to the CRR. We will use the revenue reserves of 2.5. So this will be revenue reserve account debit to CRR of around 2.5. So there will be a 2.5 lakh CRR to be created and there would be a reduction of 2.5 lakhs from the from your revenue reserves. And I guess that should be it. There's nothing other than that, I believe, over here. So if you were to review the solution for this, just a second, this is question number 5. You can say 2,50,000 share buyback, securities premium and then revenue reserves. If you had to prepare the balance sheet for this, you'll have 13 lakh 50 in your share capital, out of which 2 lakh 50 is removed. So 11 lakhs is remaining. In your reserves, out of the revenue reserve, 2 lakh 50 is transferred. Securities premium becomes 0. Profit and loss remains as it is. Capital reserve remains as it is. Capital redemption reserve remains at 2 lakh 50 and share option outstanding ideally should be taken under, because it is going to settle in own shares. So ideally it should be taken against reserves. But if the question specifically tells you that it is a part of current liabilities, you show it like that, as what the institute has done. But if nothing is given, then we'll typically say that since the settlement is happening in shares, it's not like a liability and hence you should take it in reserves. Okay. Institute has in this question, I think they've modified the question if you see in the study material, and they've removed all of these unnecessary accounts because ESOP etc. has been removed, but just in case it lands up, well, you don't know, and hence we have done it in slightly more detailed way. So other than that, you'll have long-term borrowings, short-term borrowings, current liabilities will have unpaid dividend and application money pending refund, etc. So this is taking care of question number 5. We said question number 6 is deleted because it was pertaining to differential voting rights, which have now been removed. Next you have question 7, which is done. Then is question number 8. It's an exam question, but again it's a fairly manageable question, I would say. Alpha wishes furnishes the following summarized balance sheet as on 31st March 17. The entire balance sheet is there. On 1st April 17, the company announced buyback of 25% of its equity shares at rupees 15 per share And for this purpose, it sold all investments for 150. So if you have to pass the journal entry, what are its investments? 148. Sold for 150. So there must be a gain. Bank account debit 150. To investment 148. And then there is a gain. There is a gain of how much? 2 rupees. Are we clear with this? Okay. So this will go in your profit and loss account. Fair. This is your investments which has been sold. Next, on 10th of April 17, the company achieved the target of buyback. But what was a buyback? 25%. 25% of what? Well, over here, equity shares of rupees 10 is 2,400. That is 240 shares. Into 25%, I believe this must be 60. And hence, your entry would be equity share capital account debit 60 into 10. That is equal to 600. Premium. You are buying back at what amount? 15. And hence, there is a premium of 5 rupees. 300 to share buyback 900, and hence this will be reduced by 600. Premium will be written off against securities premium if applicable. So is there a securities premium? 350. From this 300 will be written off premium, securities premium account debit to premium. And over here there would be a further payment from your bank account. This is I think 1480 minus 900. From investments, I'll receive 150 and this is 148 minus 1480. Okay. Next, what do you have? On 30th April, we'll have to transfer something to CRR as well. So how much will be transferred to CRR? Well, general reserve account debit to CRR face value, that is I think 600. So over here in general reserve, minus 530 will become 0. In your PNL, 70. So this is general reserve account debit 530, PNL account debit 70. To CRR, a capital redemption reserve will be created at 600. Perfect. Now it's a new entry over here. On 30th April 17, the company issued one fully paid up equity share of rupees 10 each by way of bonus for every 4 equity shares held by the equity shareholders by capitalization of the capital redemption reserve. So over here, your journal entry would be CRR account debit to bonus shares. Now, bonus shares are issued at face value, but how much are the bonus shares? Well, earlier I had 240 shares, out of which 60 are bought back, and hence I am left with 180 shares. And on these 180 shares, the ratio of bonus is by way of bonus for every 4 shares held. 1, so into 1 by 4, so this is 180 divided by 4, this is 45 bonus shares into 10, and hence CRR will be debited by 450, bonus shares will be credited by 450, and once bonus shares are issued, your entry is bonus shares account debit to equity share capital, that is 450. So over here your CRR, which was I think 600, pehle already tha 400 and 600, minus I will have 450. And hence your CRR will probably be 550. Securities premium will be 50. General reserve will be 0 and PNL 340. There was a profit also of 2 rupees and hence 340 minus 2 plus 70. 340 plus 2, that is 342 minus 70, and hence this comes to 272. And that's about it. So over here, if you see your solution for this question, I think question number 8, bank account debit, 2 investments to gain, perfect. Equity share capital 600, premium is 300 and 2 share buyback. Then you are making the payment. Then you have securities premium, as you can see, is utilized 300. General reserve में से 530, PNL में से 70, and that is about CRR. And then bonus shares 450 into 10, and hence there is bonus shares. So over here, if you look at your total share capital, total share capital was 2,400 minus 600 plus 450, maybe 2250. So if you go to see, there will be 2250 worth of share capital. Perfect. Then in your reserves, your revenue, your security premium is going to be 50, as we said. Securities premium is going to be 50. Your CRR was I think 550 and your PNL was 272. Revenue reserves became 0. So 600 and 272 comes to 872. Other than that, everything else will be done in the usual manner, and that should take care of question number 8 and all the questions from your classwork section. Now within the homework section, question 1 and 2 are broadly similar. There's one adjustment over there which I would say which is relevant if preference shares are issued, let's say a few months back for the purpose of buyback. Then while creating a CRR, you will consider those preference shares. Like if I read question 1 or even question 2, they are similar. D is a non-listed company furnishing the following balance sheet. You have been given this, and I've highlighted this: 2010% preference shares issued 2 months back for the purpose of buyback. Okay, so all of this is given in thousands. The company passed a resolution to buy back 20% of equity shares at 50. For this purpose, it sold all of its investment at 22 lakhs. Very basic investments were 3,000, sold at 2,200, and hence there is a 800 rupee loss which will go to the PNL. As you can see, next you will buy back equity share capital account debit, which is, let's say, 250 shares into 20% comes to 50. 50 into 10 comes to 500. 500 equity share capital account debit 500. Premium on buyback account debit, let us say 2,000 to equity share buyback account. Perfect. Share buyback account debit to bank. You will ultimately make the payment. I think that is given at the end. Share buyback account debit to bank, and then you have to write off the premium. There is a premium of 2,000 which will be written off against the securities premium account debit to premium. That is fine. And then when you have to create the CRR, we will say that your share capital is reducing by 500, and hence ideally CRR should be created by 500. However, 2 months back preference shares were issued for the purpose of financing this buyback, and hence 500 minus 200, that is equal to 300, will be the CRR to be created. Exactly on same lines is question number 2, which has a similar adjustment. Now another question that we want to review from your homework section for your LDR is question 5, and then I think question number 11 also. So these are 2 questions that we want to cover. So let us review question number 5. X furnishes the following summarized balance sheet on 31st March 18. So you have this entire balance sheet given, and the shareholders adopted the resolution on the date as follow: to buy back 25% of the paid up capital, and it is decided to offer a price of 20% over the market price. The prevailing market price is rupees 30, and hence the buyback will happen at 36 rupees per share. 30 plus 20%, that is fine. Now to finance the buyback, the company issues 3,000 14% debentures of rupees 100 each at a premium of 20%. So over here your entry will be bank account debit. This is 3,000 debentures of 100 at a premium of 20. So 3,000 into 120 will come to 3,60,000. Okay, 2 debentures which are worth 3 lakhs, 2 securities premium which is worth, I think, 0.6 lakhs or 60,000. So this is your entry for issuing debentures. Okay, next there will be issues 2,500 preferred stock of 100. So this is easy. This is bank account debit 2,500 into 100, that comes to, I think, 2,50,000, 2.5 lakhs to preference share capital. There is no premium over here, 2.5 lakhs. Acha, then sell investments of 1 lakh for 1,50,000 bank account debit. So if I go to see debentures, bank account debit, this is the entry for debentures. Securities premium, I think this is not 3 lakhs, this is 60,000 over here. Then you have bank account debit to preference shares 2,50,000, and then you are selling investments. Bank account debit 1,50,000 to investments 50 to gain on sale 50,000. Now you are required to maintain a balance of 2 lakhs in revenue reserves. So your revenue reserves cannot go below that. Later the company issues 3 fully paid shares of rupees 20 each by way of bonus for every 15 shares held by the company. Acha, but before that we need to pass the share buyback entry. Over here 25% of the paid up share capital was bought back. So 25% of, I believe this is 50 lakhs divided by 20. So this comes to 2,50,000 shares into 20% will come to around 50,000. So number of shares to be bought back will be 50,000. Now 50,000 into 20 will come to 10 lakhs. Equity share capital account debit 10 lakhs. Premium will be 26 per share. 36 minus 10. 26 into 50,000. That comes to 13 lakhs. So over here, if I go to see, your entry would be equity share capital account debit. This is 25%. I'm sorry, not 20%. My bad. So this is 25%, which comes to 62,500. So if it is 62,500 into rupees 20, 62,500 into 20 will come to 12,50,000, and into 16, 62,500 into 16 will come to 10 lakhs. And over here there will be share buyback account, and then there will be share buyback account debit to bank. Okay, However, what will you do with this 10 lakhs? We'll adjust it against the balance in the securities premium. If any, 12 lakhs minus 10 lakhs, you can adjust. In fact, 12 lakhs plus even the debentures premium has been taken over here. So this will be adjusted and that will be your balance in your securities premium. Now later you have to figure out what is to be transferred to the CRR. Now 12 lakh 50 is a reduction of share capital. However, I'm issuing new preference shares worth 2 lakh 50. And hence I believe 10 lakhs will be transferred. Debentures will not be considered for CRR working. And hence 10 lakhs will be transferred from the revenue reserves to the CRR. If you go to see, the first, I will use revenue reserves. Revenue reserves are 5 lakhs, but I need to keep 2 lakhs, which means revenue reserves will only be used for 3 lakhs. Perfect. Next, ideally, I should use the securities premium for this. No, I will use balance in P&L. Over here, they have taken it. I will probably rectify it. So over here, we will, to keep it consistent, we will say, I think the remaining 7 lakhs entirely will be taken from the profit and loss account to CRR, and they've mentioned that any other permutations, combinations are also possible. For a consistent working, we will take the 7 lakhs from the profit and loss account. Then there are bonus shares. Bonus shares, well, there were earlier 2,50,000 shares, out of which 62,500 shares were bought back, and hence 187,500 shares are remaining into 3 by 15. 187,500 into 3 divided by 15 comes to 37,500 bonus shares, and these 37,500 bonus shares will be at the face value into 20. So this will be 7,50,000. Perfect. CRR account debit to bonus shares, and then bonus shares account debit to equity share capital. And using that information, you will draw up the entire balance sheet. So this is question number 5. Other questions in the practice section are broadly similar. We have said this is similar to 7, this is similar to question 8. However, question number 11 is what is slightly different. 12 and 13 again are similar to question number 4 only. Okay, so we'll just review question number 11, and that is December 21 exam question, which is a good question. And this kind of is a summarization of everything that is done in this chapter. So let us review. Mohan Limited furnishes the following balance sheet as on 31st March 11. So you have the entire balance sheet, and the company redeemed preference shares at a premium of 10% on 1st April 2021. This is after the balance sheet date. So company redeemed preference shares at a premium of 10%. So what will be the entry? 6% preference shares of ₹50 each fully paid. This is 240. So this will be preference share capital account debit 240, premium on redemption account debit. They are redeeming at a premium of 10%. So this is 24. To, let us say, preference shareholders. This is 264. And then preference shareholders account debit to bank. So this is minus 240. There is some premium. And then preference shareholders account debit, let's say, to bank. In your bank current assets, may say maybe you will have minus 264 that you will pay for the preference shares. Now, when preference shares are redeemed, I'll have to transfer some money to the CRR. So over here, I will say CRR over here will be created. I will use the money in the general reserve, 625 hai. So I will have general reserve account debit to CRR. This will be 240. So this is from the general reserve 240 and transfer to the CRR 240. Achha, there is a premium of 24. Now this premium can be written off against the securities premium, or it can be written off against the general reserve. We prefer writing off against general reserve. Some questions institute has written off against P&L as well. Equity shares you can bindas write it off against securities premium. Preference shares can be securities premium, cannot be, depending on whether they are eligible or not. So this is point 1. It also offered to buy back maximum permissible number of shares of ₹10 at ₹30 per share on 2nd April. This is after the redemption of preference shares. Remember, this is after the redemption of preference shares, and as a result, when we now try to study the limits for question number 11, I will say that, well, first is the shares outstanding test, second is the resources test, and third is the debt to equity test. The shares outstanding, equity shares outstanding would be, I think, 78 into 25%. So this is 78 into 25% comes to, I think, 19.5. You can buy back. Next, you will have the resources. Now, while you calculate the resources, remember, you have to consider that the preference shares have been redeemed by this date, and Institute has only considered it over here. There can be some other adjustment as well, but Institute has ignored it. So when I look at the resources over here, what will be your resources? Well, your resources will include equity shares. So this will include your equity share capital. Equity share capital is how much? I think 780. It will include your other reserves. How much are the other reserves, please? So when you look at the other reserves, maybe will we take the capital reserve? No. Will we take the general reserve? Yes, but general reserve will no longer be 625. It is 625 minus 240 minus 24. And hence this is 361. Securities premium, I believe, is 52. And profit and loss is 148. So if I look at all of this, this is, I think, 361 plus 52 plus 148 will come to 561. And hence 561 and 780 will be around 1341. 1341 into 25% will come to around 335.25, and you will divide this by the buyback price, which I think is 30, and hence this is 11.175. So if I go to see over here, 11.175 is as per the resources test. Okay, and then you look at debt to equity test. Now for debt to equity test, you'll have to, I'm sorry, I think this was not working, I'm sorry. So over here, if we just recap what we were mentioning over here was, this was 780, then 561. This is the balance after deducting CRR. There is transfer to CRR as well as writing of premium. 561, so your general reserve will be after that adjustment. 625 minus 240 minus 24. This will remain the same, this will remain the same, and hence this comes to around 561. Total is 1341 into 25%, 335 divided by the buyback price, and hence 11.175 is the value as per the second condition. Now, to be honest, there is also another adjustment which the institute has ignored. It should be considered, but it is ignored. So we will also ignore that. Before you do debt to equity test, the payment for the above was made from the available balances, which appears a part of current assets, which is fine. The company had an investment in own debentures costing 60 lakhs, the face value of which is 75 lakhs, and these debentures were cancelled on 2nd April. Maybe the institute has given us 0.4, so they assume that this is done after the buyback. So maybe better is if you say that this was cancelled on 3rd April, then it will be very clear. In which case, your entry over here will be debentures account debit 75 to investment in own debentures account debit 60 to what? Profit. Now this profit will appear in the capital reserve perfectly. However, these debentures that are redeeming will actually change your loan funds, in my opinion. However, if you assume that this cancellation happens after the buyback, then your loan funds are not altered, and institute has also not altered it, so we will also not alter it. So over here, this is a slight controversial case. 268 minus, ideally 75 should go from the investments, minus 60 should go, and in the capital reserve another I think 15 has to be added. Okay, so this is pertaining to 0.4, but institute has not considered it. On 4th April, company issued one fully paid bonus share of rupees 10 each by way of every 5 shares held by the shareholders. We will generally assume that the bonus is out of CRR, required to calculate the maximum possible shares that can be bought back and record the journal entries. So over here, if I go to the third and the last test, where you look at these 3 points. Now, when I look at the loan funds, will I take debentures? Yes. But other than debentures, are there any other loan funds which are also appearing? Well, yes. Ideally, debentures should be, in my opinion, it can be 268 minus 75 if the cancellation had happened before. But if you assume it has happened after, then you will take the entire 268 plus unsecured loans. This is 36. So, institute has taken that 268 plus 36. Now, what about current liabilities? Now, if the current liabilities comprised of short-term borrowings, then this will be taken. But if current liabilities were trade payables or other current liabilities, it will not be taken. We are not taking this. Subpoint B will be the minimum equity, which is 304 divided by 2, which is 152. And then you look at the present equity. We found the present equity as 1341 sometime back under the first condition. 1341, and then you will figure out the future equity, which is 1341 minus transfer to CRR, which is X, which we will have to find. The maximum amount that you can use for the purpose of buyback, Y, which we will have to find, and then is your maximum shares, which is whatever is the amount divided by the buyback price of 30. Now for X and Y, you will make an equation that if your present equity was 1341 minus transfer to CRR, which is X, minus your minimum equity needed, which is 152 will equal y. Therefore, you will have 1341 minus 152 will come to 1189 minus x is equal to y. Again, transfer to CRR, that is x, will equal to y divided by 30. There's no innovation over here. Every time it is 30 and 10 only in all the institute material. Therefore, this is 3x equals y ultimately, and therefore 1189 minus x is equal to 3x, and therefore x equals 1189 divided by 4. This is 297.25. This is a money that you can use. No, sorry, this is x. Y, which is 3x, will be into 3, which is 891.75. So I will say 891.75 divided by 30, and this is 29.725. So this is 29.725, and hence if I look at the number of shares, I will take the least, which is 11.175. So if I look at the printed solution over here, if any, no, it is not there. So if you look at the solution for this, let us say question number 11, 19.5, 11.175 and 29.725. So this is 11.175, maximum number of shares to be bought back. 11.175 into rupees 10, that is equal to 111.75 will be the share capital debit. So your equity share capital will be debited by 111.75 and 11.175 into 20. 223.5 will be your premium debited. Now this premium will first be utilized from the balance, if any, in the securities premium, which is the remaining 52 balance, and excess, if any, will be adjusted against the general reserve to premium on buyback, and then you will have to figure out how much to transfer to CRR. Well, transfer to CRR is the shares bought back, that is 11.175 into 10. So this is 111.75 will be transferred from the general reserve to CRR, and if required, you will prepare the balance sheet for this separately. So this was a fairly interesting question, I would say, though in this question a slightly controversial impact would be the impact of this cancellation which they have not taken in the loan funds. We are assuming that because this cancellation might have happened after, that is why they might not have taken. Now if I look at the journal entry for bonus on 4th April, what is the journal entry for bonus? Rupees 10 by way of bonus shares for every 5 shares held. So this will be maybe 780 minus, or let's say 78 minus 11.175. So you're left with 68.25 divided by 5, 13.365 into 10, and hence 133.65 will be there in bonus. Maybe that entry is written, or okay, so over here CRR account debit 133.65. This is maybe your total value minus 11.175 into the bonus ratio, and that kind of takes care of this question. If you have time to revise just one question in this entire chapter, I would say that is your December 21 question, where your limits are tested, your journal entries are required. There's a redemption of preference shares as well, there's a bonus issue as well, there's a profit on cancellation of own debentures as well. So if that is one big question that you want to try in fare properly, question number 11 is that, sir, why have we taken redemption of preference shares? Because that had happened on 1st April, and hence the capital base had already reduced, and hence your revised resources available were taken. So that, I believe, takes care of the chapter on buyback. I hope you are clear with this chapter, and I'll see you with another chapter. Till then, keep studying. Good luck, goodbye, and take care.